driven based on fees. What, a self-directed or IRA that's sitting with another, fund manager, essentially, their real motive and goal, and I don't want to paint the broad picture with everyone. Most of the guys that are managing other people's money when it comes down to, making investments in the stock market, is they're really driven based on fees, right? They want to make as much fees as possible. They're not really happy when someone tries to pull out, because guess what? That just reduces their AUM, their assets under management, and their dollars in terms of fees. So I think that, that has to be tread carefully. When you have an IRA, you got to see exactly where they're investing. And generally speaking, a lot of the guys that have invested with us with their IRA, if they looked at their record of performance, their performance was only about 6%, right? Once the fees and all the other things are taken out, right? They're obviously the fund managers or the money managers are saying, hey, we're hitting 12% or 8% or 10%. But after net of fees, you're looking at about 5 or 6%, maybe 7%, right? And, there's a lot more risk with those type of investments. Whereas, for private credit, when you're investing into a private credit fund, you're the last one into the deal rather, but you're the first one out. You have so much subordinate capital that's sitting ahead of you, right? It's just a lot more safer investment than, say, the stock market, which has its ups and downs, right?